Hey guys, Lancy here. Hope everyone's doing well. So welcome to my markets videos. So I'm going to split these up because it's just easier. I also want to talk about news and things that are not really related to MTG. So if you are still interested in the MTG markets, then feel free to wait until that video comes out. If you're interested in the markets as they are right now, stocks, houses, etc., stick around in this one. So we're going to cover what happened on Friday. Now, Friday was the Jackson Hole, Jeremy Powell coming out, the Fed president, chairman, whatever. He's the one that gets the final say. So he came out and he pretty much was way more dovish than people expected. Now, there's two terms in the market which, when they look at the Federal Reserve speak, and that actually covers almost any Federal Reserve around the world. Australia's got their Reserve Bank as well. I'm sure that wherever you're from, there's a Reserve Bank of some kind. They're the ones that get to set the monetary policies, so interest rates, buying back of bonds. They're the ones that can inflate the money by purchasing bonds that are given away by companies and banks. From banks, and banks then buy it from other companies as a way to inflate the amount of money that's in circulation. Interest rates are a big one, but I know that the Federal Reserve Bank specifically buys $120 billion worth of bonds and $40 billion worth of mortgage-backed security bonds. If you haven't seen the movie The Big Short, then you can go and check that out. It's not a bad deal for them because worst case scenario, they can buy up everything that they need and pay it back with imaginary money, so they can buy up assets, and then I guess they get the money from you, the taxpayers anyway, so that it comes from our pockets, or it gets inflated away, so we lose purchasing power. It's not a good thing either ways. So explaining what happened on Friday, when the Federal Reserve chairman spoke, he sounded very dovish, which is he was not looking at the markets as things were going well. He did not mention the word tapering, which is cutting back on the $120 billion purchases or the $40 billion mortgage-backed purchases. So that price will continue to push markets and house prices up. Not a good thing if you're in the markets looking for them. It might be a good thing if you already are in the markets and have been for a while. If you're 50-50, then that's probably still okay. It's a really tricky time to let anyone know that now is a good time to jump in because obviously things are at all-time highs. But another saying goes, if things are at all-time highs, that means that the next day they can be at all-time highs again. There's nothing really stopping them. It's gambler's fallacy to expect the same number to come up in a hot streak or anything like that. It's all just chance. No one can really predict the markets. All we can do is kind of just go by, I guess, our rulers of the world and let them decide on what our fates are at this point. Anyways, as depressing as that sounds, the dollar took a massive dump. The US dollar took a massive dump, fell by 39%. It was actually more than that. It fell about 40 something percent, which is quite a big deal. But you can already see that it is still above its 200-day moving average. It's still above its 50-day. There's a pretty high chance that it might even break the 50-day. The speech that Powell gave was actually very dovish, very bad for the dollar. So while there is some strength to the dollar because it's above the 200-day moving average, which I consider a good way to predict the momentum long term or medium term of what's going to happen, and it is above the 50, there is no reason why it should stay above the 50. So I would expect it to come back, test the 200, and if it succeeds and there's something comes out saying jobs are picking up and Delta isn't that bad and all these things, oops, I said the word, maybe that'll pick back up and continue going to where we expect it to, which is up to our target of about, I'm guessing, an even 100 actually, by the time this is all said and done, and then we can decide at that point. If it falls, then really it could fall. It obviously will fall back to 89. Super strong support right there. It'll bounce off 89, probably hit the 200 again, and fall back all the way down to, I actually don't even know when the next support is. It could be a lot further down than we expect. 84 might be the next support for the dollar if it falls. 87 will be the next support, and then after that it might be 84. is the next support. And then after that, 79.29. Anyways, the resistance that the dollar has to beat is 94.3 or 94-ish. So you can see that's a pretty big resistance. And there's support at 92, which I think will be the daily moving average. Now, assuming I said that all really fast, we're going to have to see what happens. We'll see what happens when the market opens up. As you can see, the S&P 500 had a great day after the speech. If we go by what happened 15 minutes in, you can see that literally the second, there's a bit of a gap up for the S&P 500 on the start of the day, but the second Powell finished talking, or maybe when he started saying nothing about tapering, the markets just took off and then they stayed pretty high. Bitcoin, this is on the 15-minute. Yep, same thing. Took off, stayed pretty high. Now, most of these actions sadly happens during the US market, so unfortunate for the guys in Australia. Now, gold is overbought. S&P 500 is overbought. And I think Bitcoin is not overbought. Okay, so Bitcoin can continue going higher. Gold, I don't think it's not going to not go higher because what the Federal Reserve Bank said is pretty bad for the dollar, so the dollar is going to drop. Gold will go up. I just think that it's going to consolidate a bit, get rid of this overbought, so maybe even touch its that's its 50 on the 15. Let's go back to the 1 day. The 1 day at least makes sense. So you can see on the 1 day, sorry if I'm moving around too fast, you can see on the 1 day that the gold market had previously broken out of the 200 and crossed it, and there was even a golden cross, but the problem is the golden cross happened while the gold was dumping into the ground. This one, on the other hand, is looking promising because you can see there's this massive trend line that we drew ages ago, going back to 2018. Gold is now peaking over. Now we're going to see what happens in the next day. I'm expecting it to touch the 200 or maybe even come back and touch the 50, but then go back up again because there's nothing stopping it from doing that. Yeah, I really can't see anything changing right now for the dollar. It looks like it's going to be weak. It looks like the dollar is going to come back to 92, maybe test its 200. So we'll see what happens. Bitcoin's having trouble breaking out of 50,000. Very, very tough resistance. It is overbought on the daily, which means that it's above the 200 and it's doing a really good job of staying above the 200 and the 50,000. We're just going to start to see if this overbought condition goes away. Now, another thing that I'm not really a big fan of is when the momentum starts going against the price action. So you can see how the momentum is going down on the graph and the price action is moving up. That pretty much means that at some point it might break out of this and drop quite a bit lower to the downside. I just can't see that happening. The VIX, obviously the VIX takes a bit of a dump whenever the markets go up. The VIX is kind of opposite what the market says. The US 10-year took a bit of a dump as well, so now this is really bad for the 10-year. It's below the 200, it's below the 50, so yeah, there's a chance that we might actually get lower interest rates very soon. As much as people don't want to believe it, it could happen, and if it doesn't happen, then the markets might throw a tantrum just for that. The AUD-USD took an entire 1% move up, so great. That's like a 2% move right there. So yeah, 3% move right there. All thanks to the fact that the Federal Reserve actually looks even more dovish than what the Australian economy is doing right now. So I don't know what's happening in the US, but since you guys are getting stimulus and all that, we've stopped that ages ago. So hopefully things are doing okay. I don't know. Oil as well took a massive bounce up ever since the big drop. It almost hit its 200 at 12.89% gain. You'll be feeling that in the pumps very soon. There's a lot of people saying that oil is just going to go all the way up to 100. It might happen, especially if there's more issues in the Middle East. So we'll have to see. Next, the Australian markets, on the other hand, are looking very different to the US. It looks like it is starting to drop off now. Whether or not we get a stimulus or something comes up where the markets can then go, okay, that's good news, can pick it back up. Maybe if China comes up with some good news or spending bills or something, we'll see what happens. This does feel coincidental that it hits a market top right where my cross is. But like I said, anything that's dollar negative is good for almost any asset. Um, any asset at all. Like copper took off as well. It's still above its 200. It hasn't gone above its 50, but we'll see if it does on Monday. Did people want to have a look at Tesla? I guess I can put Tesla in the market. It looks good. Tesla looks good. It's in a lot of resistance overhead, but it's got a huge amount of support coming up from behind it. It's the 50 and the 200. It'll be bouncing off that for a while unless something really drastic happens. Yeah, keep an eye out for fundamental news like something out of China. ARK, maybe. ARK is not doing well, surprisingly, actually. I would expect it to do better. I feel like even though a lot of the technicals are kind of beating it down, the fundamentals is that ARK owns a lot of Tesla. I think ARK actually bought a lot of Chinese stock. Maybe that's going to cause an issue. I know that Kathy Woods got out of a lot of Chinese stock, I think at the right time. I think she recently tried to get back in, but you guys can let me know. Doge is looking okay. It's above its 50, it's above its 200. I can't tell any resistance for Doge. Shibu coin, I have no idea. This is a bit too new. Though, I mean, if you want to get your hands on it. Mara, which is, I think these guys own a lot of crypto. I think mostly Bitcoin. I don't remember, but they're doing really well. And, there might be resistance where they are right now, but they still have positive growth coming up. I think I'm going to call it that. I'm going to look at some news articles now. So the big one that I want to talk about is this right here. The federal balance sheet and the S&P 500. So pretty easy to tell that when the federal balance sheet goes up, the S&P 500 follows. I think that's about all you need to know. The federal balance sheet has been pretty consistent for a long time. And I'm going to try to bore you guys with this one, which is how do fiscal and monetary policies affect aggregate demand? Now, aggregate demand is the way of seeing what the total demand for goods and services in the economy is. So you remember when no one could buy a switch? Let's find out why that might have happened. So the way that he explains it is both the fiscal and the monetary policies can impact aggregate demand because you can influence the factors used to calculate it, which is money. So consumer spendings on goods and services, investment spendings on business capital goods, government spendings on public goods and services, exports and imports. It is often the cause of multiple trilemmas. So the fiscal policy affects aggregate demand through changes in the government spending and taxation. Those factors influence employment and household incomes, which then impact consumer spending and investments. You get taxed more, you're obviously not going to spend as much. Monetary policies, that is really distracting. Monetary policy impacts the money supply in the economy, which is a huge deal, which influences interest rates and the inflation rate, which the Federal Reserve is saying that we are now just above 2%. I think everyone knows that that's not true. It's probably way, way more than that. It also impacts business expansions, net exports, employment, and the cost of debt, and the relative cost of consumptions versus savings, all of which directly or indirectly impact aggregate demand. So, takeaways. I would normally let you guys read this, but I don't know if you put this phone away once you start listening. So, aggregate demand is an economic measure of the total demand of all finished goods or services created in an economy. It represents the overall demand regardless of the price level during a specific period of time. Aggregate demand and gross domestic product are calculated the same way and move in tandem, increasing or decreasing simultaneously. In the same way that fiscal or monetary policies impact GDP, they also impact aggregate demand. Fiscal policies impact government spending and tax policies, while the monetary policies influence the money supply, interest rate, and inflation. Now, the formula is this. Whether or not, you can get these numbers, I think most of these numbers are out there. Whether or not they're true is a different one. Understanding fiscal policy and aggregate demand. So I'll just call that AD from now on. So fiscal policy is an unusual one. I know that the governments around the world are spending a lot of money, So fiscal policy determines government spending and tax rates. Tax rates have not increased as much as people would think, but spending has. According to Keynesian economics, these programs can prevent a negative shift in aggregate demand by stabilizing employment. I keep saying unemployment among government employees and people involved in stimulated industries. Think defense to a certain point. Think transport. Think government infrastructure, building, and so on. The theory is that extended unemployment benefits helps to stabilize the consumption and investment of individuals who become unemployed during a recession. So it keeps everyone buoyant, but you're not producing anything, which means that the prices can go up. Similarly, the theory says that contractionary fiscal policy can be used to reduce government spending and sovereign debt, or to correct out of control growth fueled by rapid inflation and asset bubbles. Are we seeing that yet? I don't think anyone can see that. I mean, certainly not anyone from the government. In relation to the formula of aggregate demand, the fiscal policies directly influence the government expenditure element and indirectly impact the consumption and investment elements. God, I feel like I'm at work already. Okay, so what it's saying is in 2021, there was a huge amount of government expenditures used. You can see, look at this. See, the green is the government expenditure. Look at that spike. It had a bit of a drop in Q20, Q4, but then another spike. And I'm pretty sure that was the stimulus specifically from the US. But going back in history, we've never had anything like that. So understanding monetary policies and AD. So monetary policies enacted by central banks, Federal Reserves, by manipulating the money supply in the economy. Manipulating. The money supply influences interest rates and inflation, both of which are major determinants of employment, cost of debt, and consumption level. Expansionary monetary policies involves a central bank buying treasury notes, decreasing interest rates on loans to banks, or reducing the reserve requirement. All of these actions increase the money supply and lead to lower interest rates. This creates incentives for banks to loan and businesses to borrow. Debt-funded businesses' expansions can positively affect consumer spending and investment through employment, thereby increasing aggregate demand. It should also say in here, in either one of these, that your wages should go up. I haven't seen that yet, but that should be something that they are waiting for, because obviously if inflation happens and wages don't go up, then you've got stagflation, and no one wants that. Expansionary monetary policy also typically makes consumption more attractive relative to savings. Exporters benefit from inflation as their products become relatively cheaper for consumers in other economies. So this is localized. What happens if it happens worldwide? You just get inflation with hard to get assets going out of price. Contractionary monetary policies enacted to halt exceptionally high inflation rates or normalize the effect of expansionary policies. Tightening the money supply discourages business expansion and consumer spending and negatively impacts exporters, which can reduce aggregate demand. Okay, so the Federal Reserve does not want to do that. Neither do the governments want to see that. So we're currently looking at a very hot economy that's being pretty much propped up by the Federal Reserve banks and the governments around the world. Let me know what you guys think. I am going to call it that and continue on with my MTG video, which is way lighter on content. Sorry, I meant lighter in heart, not lighter in content. That's plenty to cover there. And thanks again, and have a good one. See you guys.